Something has shifted in the financial markets. And if you hold silver, or if you've been watching it, you need to understand what's happening right now. Over the past several weeks, we've witnessed something unusual. Silver, which for years has been trading with its own distinct personality, has begun moving in near lockstep with Bitcoin. When Bitcoin drops, silver drops. When Bitcoin rallies, silver follows. This correlation wasn't there 6 months ago. It wasn't there a year ago, but it's here now. This matters because it suggests something deeper is changing in how markets function, in how liquidity flows, and potentially in how the decades-old paper silver market is beginning to crack under its own weight. I'm not here to tell you silver is going to the moon tomorrow, or that the system is collapsing next week. I'm here to walk you through what's actually happening, why it's significant, and what thoughtful investors should be paying attention to as this unfolds. If you already own physical silver, you need to understand what this price action means and what it doesn't mean. If you don't own any, you need to understand whether this volatility represents risk or opportunity, and how to think about it without getting swept up in emotion. This is a conversation about market structure, liquidity, cycles, and the long game. Let's begin. The first thing we need to acknowledge is the correlation itself. Silver and Bitcoin are fundamentally different assets. One is a physical metal with thousands of years of monetary history. The other is a digital asset barely 15 years old. They have different supply dynamics, different holder bases, and different use cases. Yet, in recent weeks, their price charts have been moving together with unusual precision. This tells us that something external to both assets is driving their movements, that something is liquidity. When we see two different asset classes moving in tandem, it usually means traders and algorithms are treating them the same way in terms of risk positioning. Both are being sold when liquidity tightens. Both are being bought when liquidity loosens. The assets themselves haven't changed. The market's treatment of them has. This is not a permanent state of affairs, but it is a signal. It tells us that in the short term, markets are being driven by flows, by the movement of money itself, rather than by fundamentals. It tells us that volatility is being driven by position unwinding, by forced selling, by margin calls, by the mechanical aspects of modern markets, rather than by a change in silver's actual supply and demand story. Here's what makes this moment different from typical volatility. We're seeing this correlation emerge at the same time that physical silver premiums remain elevated, delivery times stay extended, and mints continue reporting strong demand. The paper price is dropping while the physical market shows tightness. That disconnect is what has people asking whether the paper market is beginning to break. Let's talk about what paper silver breaking actually means, because this phrase gets thrown around without much precision. The silver market, like gold, operates on two levels. There's the physical market, actual metal that can be held, stored, and delivered. Then there's the paper market, futures contracts, options, exchange-traded funds, and various derivatives that represent claims on silver without necessarily involving physical metal changing hands. The paper market is vastly larger than the physical market. For every ounce of physical silver that exists, there are multiple paper claims on that silver. This system works fine, as long as most participants are willing to settle in cash rather than demanding physical delivery. It's worked this way for decades, but it's a system that depends on confidence. It depends on the assumption that paper and physical are essentially interchangeable, that the price discovered on futures exchanges accurately represents the value of the metal you can hold in your hand. When we talk about the paper market breaking, we're talking about that confidence eroding. We're talking about a widening gap between what silver costs on a screen and what it costs to actually acquire physical metal. We're talking about delivery failures, about contract settlements being pushed out, about premiums that don't compress even when the spot price drops. We're not there yet, but we're seeing the early signs that stress is building in the system. To understand why this is happening now, we need to zoom out and look at the broader financial landscape. None of this is occurring in a vacuum. We're living through the aftermath of the most extraordinary period of monetary expansion in human history. Since 2008, and especially since 2020, central banks have created currency at a pace that would have been unthinkable to previous generations. That money didn't disappear. It's still in the system, looking for a home. At the same time, we're now in a period where interest rates, while off their lows, remain historically unusual. The cost of money has been manipulated for so long that price discovery across all markets has been distorted. When rates finally move meaningfully, either up or down, that adjustment forces a repricing of everything. Add to this the growing understanding among institutional investors that currency debasement is not a temporary phenomenon, but a structural feature of modern government finance. Debt levels across developed nations are at peacetime records. The political will to reduce spending does not exist. The mathematical reality is that this debt will either be serviced through inflation, default, or financial repression. None of those outcomes are good for holders of currency. This is the context in which silver finds itself. It's an asset that historically performs well during periods of currency stress, but it's also an asset that can be volatile in the short term as markets adjust to changing liquidity conditions. Right now, we're in one of those adjustment periods. Let's talk about what happens psychologically during moments like this, because understanding your own reaction is as important as understanding the market itself. When you watch the price of something you own drop sharply, your brain interprets it as a threat. This is biology, not rationality. The same neural pathways that helped our ancestors survive physical danger are now firing in response to numbers on a screen. You feel an urge to act, to do something, to make the discomfort stop. This is why most investors lose money. They buy when they feel confident, after prices have already risen, and they sell when they feel afraid, after prices have already fallen. They're always acting on emotion, always one step behind, always transferring wealth to those who can stay calm. The investors who build lasting wealth are the ones who have learned to separate price from value. They understand that volatility is the cost of admission to asymmetric returns. They know that the best opportunities often come disguised as crisis. They've trained themselves to feel interest rather than fear when markets dislocate. If you own silver and you're feeling anxious watching the price drop, that's normal. But that feeling is not useful information about what you should do. What's useful is asking yourself, has the reason I bought this asset changed? Has the long-term thesis been invalidated? Or is this simply the market being the market, moving in ways that feel dramatic in the moment, but are ultimately noise in the context of years? When we look past the price action and examine what's actually happening in the silver market, we see a complex picture. On the supply side, silver mine production has been essentially flat for several years. New major discoveries are rare. The silver that comes out of the ground is increasingly a byproduct of other mining operations, which means supply is somewhat inelastic. It doesn't respond quickly to price signals. On the demand side, industrial use continues to grow, particularly in solar panel production, electronics, and emerging technologies. Silver is uniquely positioned as both a monetary metal and an industrial commodity. This dual nature is both a strength and a source of volatility. Investment demand is harder to quantify, but the available indicators suggest it remains robust. Physical coin and bar sales from major mints, while off their peak, remain well above historical averages. Flows into physical-backed silver funds continue, even as price-sensitive traders exit. Long-term holders appear to be holding. What we're seeing in the price, then, is not a fundamental deterioration in silver's story. It's a liquidity event. It's the market adjusting to changing conditions in ways that are mechanical rather than fundamental. This is important to understand because it changes how you think about the situation. Silver has always been volatile. This is not new. What we're experiencing now has precedence, and looking at how similar situations resolved in the past can provide context. In 2008, during the financial crisis, silver dropped from over $20 to below $9 in a matter of months. Many people thought the silver bull market was over. They sold. Within 2 years, silver had not only recovered, but had blown through its previous highs. By 2011, it briefly touched $50. In 2013, silver experienced a sharp correction that took it from over $30 down to below $20 in a few months. Again, many investors capitulated. Again, that proved to be a mistake for those who were thinking in terms of years rather than months. In March 2020, in the initial panic of the pandemic, silver dropped from over $18 to below $12 in a matter of weeks. Physical metal disappeared from dealers even as the paper price was crashing. That disconnect was the most extreme in modern history. Those who bought physical silver during that period were rewarded handsomely as the price more than doubled over the following year. I'm not telling you these stories to suggest that history will repeat exactly. I'm telling you these stories to illustrate that volatility and even severe corrections are normal features of silver's behavior. They are not signs that the asset is broken. They are signs that markets move in cycles, and those cycles include drawdowns that shake out weak hands and test conviction. Now let's address the elephant in the room, the structure of the silver market itself, and whether it can continue functioning as it has. The concentration of short positions in the silver futures market has been a topic of debate for years. A small number of large institutions hold short positions that represent staggering amounts of physical metal, amounts that couldn't possibly be delivered if everyone holding long contracts demanded physical settlement. This is not conspiracy theory. This is documented in regulatory filings. The question is whether it matters, and if so, when and how it matters. For decades, the system has worked because most participants don't want physical metal. They want price exposure, liquidity, and the ability to trade in and out of positions easily. The futures market provides that. Physical metal does not. But there's growing evidence that the composition of silver buyers is changing. More institutions are seeking physical exposure. More countries are considering or implementing policies that favor tangible assets. More individual investors, having lived through multiple currency crises, are prioritizing physical ownership. If this trend continues, If a growing percentage of market participants insist on physical settlement rather than cash settlement, the system will face stress. We may be in the early stages of that stress now. The price volatility we're seeing could be, in part, the market beginning to grapple with a structural problem that's been building for years. If you already own physical silver, here's what you need to understand about this moment. First, if you bought silver as long-term portfolio insurance, as a hedge against currency debasement, or as a store of value across time, then nothing about your thesis has changed. The paper price dropping doesn't make your metal disappear. It doesn't change the supply constraints. It doesn't change the debt dynamics driving currency weakness. It doesn't change the historical role silver has played during monetary transitions. What it does do is test your conviction. It asks whether you actually believe what you say you believe, or whether you were just along for the ride hoping for quick gains. This is uncomfortable, but it's also clarifying. Second, understand that paper price and physical availability are increasingly diverging. If you try to sell your physical silver right now, you'll get close to the spot price minus a small dealer markup. But if you try to buy physical silver right now, you'll pay spot plus a significant premium that hasn't compressed despite the price drop. The spread is telling you something about where real supply and demand meet. Third, manage your emotional state. Turn off the price tickers if you need to. Stop checking every day. Remember why you allocated to silver in the first place. If those reasons remain valid, then short-term volatility is just noise. If those reasons have changed, then you need to reassess, but do so rationally, not reactively. The worst thing you can do as a physical silver holder right now is to panic sell at the bottom, locking in losses, only to watch the price recover and wish you'd held on. This scenario has played out countless times. Don't be another example of it. If you don't currently own silver, this moment presents a different set of considerations. First, understand that volatility works both ways. The same forces creating downside volatility can create explosive upside volatility when sentiment shifts. Silver is not a stable asset. It's not appropriate for money you need in the short term. It's not suitable for people who can't psychologically handle watching the value fluctuate. Second, if you've been considering adding silver to your portfolio as part of a broader strategy of diversification and currency hedge, periods of price weakness historically have been better entry points than periods when price is rising and everyone is excited. The best time to buy any asset is when it's out of favor, unloved, and most investors are looking elsewhere. Third, do not bet money you can't afford to lose. Do not overallocate. Do not use leverage. Silver should be a component of a diversified strategy, not a concentrated bet. The people who get hurt in volatile markets are the ones who are overextended, who bought more than they could afford, who are forced to sell at the worst possible time because they need the money. If you decide to allocate to silver, focus on physical metal, not paper proxies. Buy from reputable dealers. Understand what you're paying in premiums. Plan to hold for years, not months. And make sure you have the financial stability and emotional temperament to weather volatility without being forced into decisions you'll regret. Let's dig deeper into the liquidity dynamics that are driving much of what we're seeing. In modern markets, liquidity is not a constant. It expands and contracts based on central bank policy, based on the appetite of market makers to take the other side of trades, based on the amount of leverage in the system, and based on investor confidence. When liquidity is abundant, everything goes up together. Stocks, bonds, real estate, commodities, crypto, all asset classes benefit from the rising tide of easy money. Correlations break down because there's enough capital flowing in to lift all boats. When liquidity contracts, everything goes down together, at least initially. Correlations spike because forced selling doesn't discriminate. Margin calls don't care about fundamentals. Algorithms don't care about value. They care about covering positions, meeting requirements, reducing exposure. This is what we're seeing now. Bitcoin is highly sensitive to liquidity conditions. Silver, particularly paper silver, is also sensitive to liquidity conditions. So they're moving together, not because they're the same asset, but because they're both being buffeted by the same liquidity winds. The key insight is that this is temporary. As the dust settles, as forced selling subsides, as capital redeploys, correlations will break down and fundamentals will reassert themselves. The question is simply how long that process takes and how volatile the path is along the way. One of the ongoing debates in financial circles is whether we're headed for inflation or deflation, and what that means for assets like silver. The truth is that we may experience both, just in different sequences or in different parts of the economy. We may see deflation in asset prices while seeing inflation in necessities. We may see disinflation in official statistics while experiencing inflation in lived experience. The economy is complex, and simple narratives often miss important nuances. Silver historically has performed well in both highly inflationary environments and in post-deflation recovery periods. It's struggled most in environments of stable, moderate growth with low inflation and confidence in the financial system. We're not in that kind of environment now, and we're unlikely to return to it anytime soon. What matters more than whether we technically have inflation or deflation is the trajectory of currency purchasing power over time. Every major currency in the world is being debased. Every major government is running deficits that can only be financed through money creation or financial repression. Every major central bank has demonstrated that when faced with crisis, it will print currency rather than allow systemic failure. In that context, tangible assets with limited supply and enduring utility have value. They're not a perfect hedge. They're volatile. But over long periods of time, they preserve purchasing power better than paper claims that can be created without limit. This is one of the most important sections of this entire discussion, because knowing what not to do is often more valuable than knowing what to do. Do not panic. Sell your physical silver because the paper price is dropping. If you sell physical metal at the bottom, you will almost certainly regret it. You will have converted a temporary paper loss into a permanent real loss. You will have given up your insurance policy right before you might need it most. Do not use leverage to try to catch the bottom. Do not buy silver futures with borrowed money. Do not max out credit cards to buy more physical metal because you think this is your last chance. Leverage destroys investors during volatile periods. It turns manageable volatility into catastrophic loss. The path to wealth in hard assets is through patient accumulation without leverage, not through aggressive betting. Do not obsess over short-term price movements. Checking the price every hour, every day, even every week is counterproductive. It keeps you in a state of emotional reactivity. It tricks your brain into thinking that short-term volatility is important information when it's mostly noise. Do not blindly follow predictions from social media personalities who promise that silver is going to a specific price by a specific date. No one knows the future. Anyone who claims certainty is either deluded or selling you something. The people with real expertise speak in probabilities, in scenarios and ranges. They acknowledge uncertainty. Be skeptical of anyone who doesn't. Do not neglect the rest of your financial life. Silver is one piece of a financial plan. You still need emergency savings. You still need to minimize bad debt. You still need to invest in your skills and earning power. You still need to live within your means. Silver is not a substitute for financial discipline in other areas of your life. If I could distill everything we've discussed into one principle, it would be this. Patience is the most valuable asset in volatile markets. The investors who build lasting wealth are not the ones who are the cleverest or the most aggressive. They're the ones who can wait. They're the ones who can sit through volatility without flinching. They're the ones who understand that markets move in cycles, that extremes are temporary, that value eventually gets recognized. This doesn't mean being passive. It doesn't mean never adjusting your strategy. It means having a plan, sticking to that plan unless conditions fundamentally change, and not allowing short-term market movements to shake you out of positions that still make long-term sense. In the case of silver, patience means understanding that this is a multi-year story. It means accepting that the path from here to there will be volatile. It means recognizing that the biggest gains often come after the biggest tests of conviction. The investors who bought silver in 2008, after it had been cut in half and then held through 2009 and 2010, were rewarded with massive gains. But they had to be patient. They had to endure a period where it felt like they'd made a terrible mistake. They had to hold while the financial media was declaring commodities dead. We may be in a similar moment now, or we may not be. The point is not to predict the exact timing. The point is to have the temperament to hold quality positions through volatility, to add to positions when others are fearful, and to maintain conviction in your thesis until evidence emerges that the thesis has changed. Let's zoom all the way out and look at the forest rather than the trees. We're living through a period of profound monetary transition. The financial system that emerged after World War II, that was restructured in 1971 when the dollar was severed from gold, that was patched together in 2008 with unprecedented money printing, that was blown apart and hastily reassembled in 2020, that system is showing signs of strain. This doesn't mean the system will collapse tomorrow. Complex systems are more resilient than crisis predictors imagine. But it does mean that the rules are changing, that old assumptions are being questioned, that trust in traditional financial assets is eroding, and that investors are searching for alternatives. Silver sits at an interesting intersection in this transition. It's a monetary metal with thousands of years of history, but it's also an industrial commodity with modern applications. It's scarce enough to preserve value, but abundant enough to be practical for transactions. It's recognized globally, but priced affordably enough for ordinary people to acquire. Whether silver ultimately plays a major role in the next monetary system, or simply serves as a store of value for those who distrust the current one, it occupies a unique position in the portfolio of assets that maintain purchasing power across time. The volatility we're seeing now is the market grappling with these larger questions. It's price discovery in real time, with all the messiness and uncertainty that entails. It's uncomfortable to live through, but it's also opportunity for those positioned to take advantage. Let's talk practically about managing risk in this environment. First, Position sizing matters enormously. If you've allocated such a large percentage of your net worth to silver that volatility is causing you genuine stress, you're probably overallocated. A properly sized position is one you can hold through significant volatility without being forced to sell and without losing sleep. For most investors, that means silver should be somewhere in the range of 5 to 20% of investable assets, depending on risk tolerance and conviction. It should not be 50% or more unless you're in a unique situation with extensive experience and no need to access that capital. Second, diversification within hard assets can reduce volatility. Silver is more volatile than gold. Platinum has different drivers than silver. Even within precious metals, spreading allocation can smooth returns and reduce the impact of any single asset's volatility. Third, maintain liquidity outside of your silver position. You need cash reserves for emergencies. You need accessible capital for opportunities. Silver is not liquid in a crisis. It can take days or weeks to sell physical metal, and you'll take a haircut in the process. Never put yourself in a position where you might be forced to sell physical silver to meet an unexpected expense. Fourth, understand the difference between trading and investing. If you're actively trading silver, trying to time moves, buying and selling based on short-term signals, you're playing a different game than someone who's accumulating physical metal as long-term insurance. Both approaches can work, but they require different skills, different temperaments, and different amounts of time and attention. Most people are better served by the latter approach: steady accumulation, long-term holding, minimal trading. One of the hardest truths in investing is that timing the market consistently is impossible. You will not buy at the absolute bottom. You will not sell at the absolute top. Trying to do so will drive you crazy and almost certainly cost you money. What you can do is identify periods when risk-reward is favorable and periods when it's unfavorable. Right now, with silver having declined significantly, with sentiment negative, with many investors having capitulated, risk-reward looks more favorable than it did when silver was higher and everyone was excited. Does that mean this is the bottom? Maybe, maybe not. The bottom might be here, it might be 10% lower, it might be 20% lower. We don't know, and pretending we do is foolish. But what we can say is that probability favors accumulation during periods of pessimism over accumulation during periods of euphoria. We can say that historically, buying after significant declines has worked better than buying after significant advances. We can say that if the long-term thesis remains intact, then price weakness is opportunity rather than danger. The most successful investors use strategies that don't require perfect timing. Dollar cost averaging into a position over time, building a core position and adding on weakness, setting aside emotion and following a predetermined plan. These approaches won't maximize gains in every scenario, but they avoid catastrophic mistakes and keep you in the game. If you're relatively new to thinking about silver, about hard assets, about monetary policy and how it affects your financial future, this might all feel overwhelming. That's okay. This is a learning process, and it takes time. The most important thing you can do is educate yourself, not by watching hype videos or reading sensational headlines, but by studying the fundamentals. Understand how money is created. Understand the history of currency debasement. Understand supply and demand dynamics for physical commodities. Understand the difference between saving and speculating. Read books by people who understand economic cycles and monetary history. Study what happened during previous periods of monetary transition. Look at what's worked in the past and what hasn't. Build a framework for thinking about these issues so that when volatility hits, you have context and aren't just reacting to fear. Start small if you're going to allocate to silver. Buy an amount that won't keep you up at night if it drops 30%. Get familiar with how it feels to own a physical asset that fluctuates in price. Learn whether you have the temperament for this kind of investment before you commit significant capital. And remember that education is ongoing. The more you learn, the more you realize how much you don't know. The people who get into trouble are the ones who think they have it all figured out after reading a few articles. Maintain intellectual humility, stay curious, keep learning. So where do we go from here? What should you be watching? What matters? In the short term, watch liquidity conditions. Watch central bank policy. Watch for any signs that the paper and physical markets are dislocating further. Watch for delivery failures or unusual premiums that don't normalize. Watch for changes in institutional behavior around physical holdings. In the medium term, watch debt dynamics, watch currency trends, watch for political or geopolitical developments that might accelerate loss of confidence in traditional financial assets. Watch for shifts in how younger investors think about money and value. In the long term, watch the macro story. Is global debt continuing to expand? Are central banks continuing to create currency? Are governments continuing to run deficits? Is trust in the financial system being restored or further eroded? These are the big forces that will shape whether this decade looks like the 1970s, the 1940s, or something entirely new. But more important than watching all of this is maintaining your own discipline, having a plan and sticking to it, avoiding emotional decisions, staying educated, thinking in terms of years and decades rather than days and weeks. The investors who will look back on this period with satisfaction are not the ones who got the timing exactly right. They're the ones who had a reasonable thesis, who acted on it with appropriate position sizing, who maintained discipline through volatility, and who didn't let emotion override strategy. We opened this conversation by acknowledging that something has shifted. Silver is moving with Bitcoin in ways that suggest liquidity stress. The paper price is diverging from physical availability. Volatility has returned with force. Many investors are feeling uncertain, anxious, and looking for answers. Here's what I want you to take away from everything we've discussed. First, volatility is not a sign that your thesis is wrong. It's the price of admission to asymmetric opportunity. If you can't handle volatility, you shouldn't be in volatile assets. But if you can handle it, if you can stay calm and rational, volatility becomes your friend rather than your enemy. Second, the fundamentals driving interest in silver, currency debasement, debt expansion, supply constraints, growing industrial demand, declining confidence in traditional financial assets, haven't changed. The price has changed. Your feelings about the price have changed, but the underlying story remains intact. Third, time horizon matters more than almost anything else. If you're thinking in terms of months, this volatility is terrifying. If you're thinking in terms of years or decades, it's just noise. Adjust your perspective to match your actual investment timeline. Fourth, what you do matters more than what you know. Knowledge without action is useless, but action without knowledge is dangerous. Educate yourself, develop a plan, execute that plan with discipline, and then have the patience to let it work. Fifth, this moment will pass. In 6 months, in a year, in 5 years, we'll be dealing with different headlines, different crises, different opportunities. The investors who build lasting wealth are the ones who can keep perspective during moments like this, who understand that this too shall pass, who don't let temporary volatility derail long-term strategy. The financial landscape is changing. That much is clear. But change creates opportunity as much as it creates risk. The question is whether you're positioned and prepared to take advantage, or whether you're going to be swept along by emotions and headlines. Stay calm, stay informed, stay disciplined. Focus on what you can control, your allocation, your time frame, your emotional state, your continued education. Let go of what you can't control, the day-to-day price, the sentiment on social media, the predictions of talking heads. The crisis may be here, as the title suggests, or this may simply be another chapter in an ongoing story of monetary transition that unfolds over years rather than months. Either way, the principles remain the same. Understand cycles, manage risk, think long-term, stay rational. If you do those things, you'll be fine, more than fine. You'll be positioned to navigate whatever comes next with confidence rather than fear, with opportunity rather than anxiety. Thank you for investing your time in this conversation. Stay thoughtful out there.